Hello and welcome to Switzer Investing Insights, brought to you by NAB Trade. It's week 3 of earnings. The spotlight this week is BHP, A2 Milk and Coles. Paul, let's kick off with the big miner.
Yeah, the big Australian, Peter, underlying profit up 2% to US $9.1 billion. A little weaker than the market had forecast. Yeah. Net profit of $8.3 billion US dollars, mainly due to an exceptional loss to do with the Samarco mine. Despite that, the EBITDA flat at $23.3 billion, so that's a little disappointing. I suppose for shareholders, the big news is a full year dividend of US $1.33. That's higher than the market was forecasting, including a final of 78 US cents. That compares with about $1.18 last year, and that's about $2 roughly Australian. So big dividends coming back from BHP. And just looking at this financial year for BHP, something like $17.1 billion US dollars has come back to shareholders through an off-market buyback, the special dividends and big ordinary dividends. So shareholders have been getting a lot of riches back from BHP. Look, highlights of results, Peter. Look, they're mainly financial highlights because BHP really hasn't been able to increase productivity or improve volumes to any extent. Return on capital employed, 16.1%, up from 14.4% last year.
Which is good.
Net debt down to $9.2 billion. The gearing ratio, pretty conservative, just 15.1%. Dividend, I mentioned a payout ratio of 74%. That's the ordinary dividend. They have a target of at least 50% of ordinary earnings, so there's probably just a question mark about the sustainability, but it does show that they're pretty confident about their ability to generate cash. CapEx, $7.6 billion and under their original forecast, and they're also suggesting under $8 billion for next year. And they say that all their major projects are on time and on budget. That's always a great thing to hear from a company. Negatives, well, look, they had negative net productivity of US $1 billion. So that means they actually went backwards in the productivity stakes. Now, they blame things like resource headwinds. This is obviously mines do become less productive over time, and a lot of unplanned outages and some big weather events, some cyclones up the northwest of Australia.
They are vulnerable businesses.
They are vulnerable business. There are also some higher cost pressures as well. EBITDA was flat, which is mainly due to some cost growth, and then there's challenges for the returns from their copper division.
Okay, 2 questions, Paul. One is, what is the yield on this approximately, and is BHP a buy, hold, or
Yeah, look,
sell?
I wrote a piece, is BHP becoming a yield player? We always talk about never buy resource stocks for dividends or dividends alone. Look, it's yielding about 5.5% on the current dividend, or it's almost 8% when you add in the benefit of franking, so fairly attractive. I guess the question mark is the good news about BHP, great balance sheet, the company's doing nothing wrong, it's very sensible, not going out there and what we always fear with mining companies and buying projects at the top of the cycle, but they have no control over their price takers, no control over of what they get for iron ore, for copper. They're a little more optimistic on the copper price. The iron ore price, look, they still think China looks okay, but a lot of it has been to do with, of course, the disruptions to the supply from their competitor Vale in Brazil. And that's prices come down a bit. But look, I think BHP's a hold, Peter. I mean,
don't sell.
I wouldn't be rushing into BHP at this point in the cycle. But conversely, look, they're very disciplined, very fiscally responsible, and you know, if you get a bit of an upswing in the cycle in the commodity prices, shareholders will get the cash flow.
Good result in that respect. Let's go to A2 Milk, Paul.
Now, this result disappointed the market, Peter, and the shares came off about 14%. They've had a good run up, I should point that out, but and they are a good company. And this is despite, on paper, some pretty encouraging numbers. Revenue up 41.4% to a bit over $1.3 billion. Interestingly, despite we talk a lot about China, 2/3 of that revenue still comes out of Australia and New Zealand. Net profit up 47%. But the bit that the market didn't like is what's called their EBITDA to sales margin. So how much is of every dollar they sell, how much do they actually retain? What are they actually spending to actually get that sale? Now, for the full year, that was 31.7%, but it came off into the second half down to 28.2%. And the point that the market didn't like is they guided to that margin roughly being about the same next year. In other words, to get the same sort of sales, you know, A2 Milk is having to spend more on things like advertising to drive sales, and that's a function of competition. So for very high growth business where the market's starting to think competition's intensifying, that's throwing out a few red lights, and that's why the price came down. I think A2 Milk is worth looking at again. I'm a bit worried worried because we've seen in this earnings reporting cycle, when stocks get clobbered, they tend to take a while to get to regain.
Yeah. The big sell-offs at earnings time those companies can be down for quite some time.
Yeah, so apart from the market starting to think that it's going to be much harder for A2 milk going forward, I think it's actually looks quite a bit interesting. But I put the caveat out there about looking at the market's initial judgment.
Okay, let's go to the next one, Coles.
Yeah, so Coles is a bit strange. It was spun off from Wesfarmers. This result covers a full 12 months, but some things like the dividend only cover about a 7-month period. So there's a few other funny things going on. So total sales, excluding the fuel business, and they've changed the arrangements in terms of what goes on with fuels with Coles Express, up 3.1% to $35 billion. The earnings before interest and tax and pre-significant items down 8.1% to $1,325 million. And that was almost due solely to the Coles Express business. They declared a maiden dividend of 35.5 cents fully franked, comprising a 24-cent ordinary dividend and a special dividend of 11.5 cents. That in aggregate, that's higher than expected.
Yep.
That covers a 7-month period. I guess the issue here is the breakup between the ordinary and the special. What are they telling us going forward? But let's take it while we can. What are the highlights? The earnings from the supermarket business, which is about 90% of the Coles business, that was actually up 2.2%, Peter. The first growth in EBIT from supermarkets since 2016, so that's a positive.
Yep.
They had comparable store sales growth of 2.7%, although the second half was weaker than the first half. The liquor division, in comparison, only $120 million in earnings, but that was up 8.4%. And I mentioned the dividend was higher than expected. The negatives, well, despite an improvement in gross margin in supermarkets and sales that grew overall EBIT growth, the margin actually declined 4 basis points to 3.8%, and that's really due to higher costs of doing business. That's a negative, so be careful of that going forward. They've also warned that comparable store sales growth, they've had 46 or 47 consecutive quarters. We actually may see a decline in the first quarter of 2020, in part due to the cycling off of the promotion of the
those mini products.
Mini products at the same time. They've got the promotion going again this
Little
time. Little shop, but probably not going to have the same improvement. And probably suggesting that Woolworths have made up more ground. So this is actually probably quite a positive for Woolworths, this result. And while fuel volume is helping Express, earnings growth is still expected to remain subdued in FY20.
Right. Two questions with this, Paul. I think a lot of people. What is the approximate yield plus franking, and is the buy, seller or hold?
Yeah, I think we can probably pencil in the yield of about 4% for Coles.
Plus franking.
And then franking adds another sort of 1.5% or so to that. Look, I mean, I guess, is it a buy? Look, it's interesting, I think, but not compelling. I mean, that's a reasonable yield. There's not much
I guess
growth.
it's almost 5.5%. It's not a bad way to get it.
I think where Coles is priced is towards the top end of the range. It's no super buy for me, but then we've seen this monumental change in interest rate outlooks, and some would say that 4% plus franking, reasonably low risk, is attractive. Yeah. Look, it's probably for the income seekers. I don't think you get a lot of growth here, so for me, Coles is not a buy at these levels.
Okay, so that's Switzer Investing Insights, brought to you by NAB Trade. Thanks for joining us.